The moment you leave your job, 5 elements vanish from your financial picture that have been present for 20, 30, possibly 40 years. Not slowly, not incrementally. They disappear on your final day, and the tax authority does not mail you a notice explaining what was lost or how to compensate for it. Most retirement content focuses on what you receive when you stop working. Liberty, leisure, adaptability, and those benefits are genuine. But nobody discusses what the tax system silently strips away the instant your salary ends. These are not minor details. Every single one was shielding you from handing over more in taxes than necessary. Every single one was lowering your reportable income, guarding your nest egg, or holding the tax collector at bay. And when they vanish, the tax ramifications strike in ways most individuals do not uncover until their first spring as a retired person. When the statement comes, and it is thousands of dollars larger than they anticipated. I am going to guide you through all 5 individually with actual figures. By the conclusion of this video, you will understand precisely what you are poised to forfeit, what it was providing, and the exact measures you can implement to substitute each one before or right after you leave the workforce. Before I dive in, I must be transparent. I'm not an attorney, I'm not an accountant, I'm not a financial consultant. Nothing in this video constitutes legal, tax, or investment guidance. These are instructional illustrations grounded in existing tax regulations and publicly accessible tax authority data. Always speak with a certified tax specialist for your individual circumstances. My background is in retirement tax education, and if you're unfamiliar with this content, this platform serves one particular audience, retirees and soon-to-be retirees beyond 60, who want to grasp how the tax system truly operates in retirement. Not the summary your company provided at the farewell meeting, the actual version with genuine calculations in straightforward language. If that describes you, subscribe immediately, because the video I'm releasing next week will reveal the precise month you should retire to minimize your tax burden. And that one is going to alter some of your schedules. Leave a comment right now. Have you already left work or are you still employed? Simply retired or employed? I review every single response, and the ratio between those two categories will determine whether my subsequent video concentrates on avoidance or remediation. 2 seconds, do it now, let us begin. Item number 1, the tax system eliminates your automated tax payment infrastructure. This is the one that catches new retirees off guard more than anything else. And it is so straightforward that people overlook it until the fine shows up. Throughout your entire professional life, your company deducted federal income tax from every paycheck and forwarded it to the tax authority for you. You never needed to consider it. You never skipped a remittance. You never received a fine. The mechanism operated independently. The moment you retire, that mechanism ceases entirely and nothing automated takes its place. Your retirement revenue originates from varied sources now: Social Security, retirement account distributions, pension checks, investment earnings, perhaps some property income. And here is the issue. Most of those revenue streams either do not subtract taxes whatsoever, or they subtract an incorrect amount. Social Security will deduct a fixed percentage if you request, but it is typically insufficient. Retirement account distributions default to 10% deduction, but your true tax bracket might be 22%. Pension deductions fluctuate enormously depending on how you completed the paperwork. The tax authority requires you to remit your taxes throughout the year in 4 quarterly installments: April 15th, June 15th, September 15th, and January 15th. If you miss those deadlines or pay too little, the tax authority imposes an underpayment fine. In 2026, that fine rate is roughly 7 to 8% yearly on the shortfall amount, figured quarterly. Let me illustrate what this means in actual dollars. Suppose your total tax obligation for 2026 is $14,000. You had $8,000 deducted throughout the year from Social Security and retirement account distributions. That leaves $6,000 underpaid. You did not submit any estimated remittances because nobody informed you to. The tax authority computes the fine on the $6,000 across 4 quarters. When you tally it all up, you're facing $300 to $500 in fines on top of the $6,000 you already owe. That is money you surrendered to the tax authority for zero reason. The tax was identical regardless. The fine was completely preventable. I had a subscriber contact me last month who retired in March of 2025. Her revenue for the year consisted of 3 months of wages, Social Security beginning in July, and retirement account distributions for daily expenses. Her wages had 10% federal deduction. Her Social Security had 0 deduction because she never submitted a Form W-4V to arrange it. Her retirement account provider deducted 10%, but her true tax rate on the combined revenue was nearer to 18%. When she submitted her 2025 filing in February 2026, she owed $3,800 plus a $212 underpayment fine. She had no clue the fine existed. She had no clue she was expected to submit estimated remittances. Nobody at her company brought it up during her departure meeting. Nobody at Social Security brought it up when she initiated her benefits. The tax authority did not issue a caution. They simply computed the fine on her filing. That $212 was entirely preventable if she had submitted Form W-4V with the Social Security Administration to deduct 7, 10, 12, or 22% from her monthly payment. And if she had instructed her retirement account provider to deduct 18% rather than the standard 10, her deductions would have satisfied the obligation. No estimated remittances required, no fine. Here is the precise action. When you begin receiving Social Security, submit Form W-4V to establish your deduction rate. You have 4 options: 7%, 10%, 12%, or 22%. Select the one nearest to your anticipated marginal bracket. When you arrange retirement account distributions, contact your provider and configure the deduction to correspond with your true tax rate, not the standard amount. These 2 calls require 10 minutes total, and they eliminate the fine problem for the duration of your retirement. Now, there is positive news. The tax authority has an exemption designed for older Americans. If you are 62 or above and you retired within the past 2 years and you had legitimate grounds for underpaying, they can dismiss the fine completely. But the exemption does not occur on its own. You have to submit Form 2210 with your filing and mark the designated box. If you merely file normally and settle the balance, you absorb the fine and never learn the exemption was available. There's additionally the safe harbor provision. If you remit 100% of what you owed in the preceding year through deductions and estimated remittances, or 110% if your revenue exceeded $150,000, you will not face penalties regardless of what your actual tax obligation proves to be. That safe harbor is among the most valuable safeguards in the tax regulations. The solution is this. The week you retire, navigate to IRS.gov/payments and establish quarterly estimated tax remittances. Use Form 1040-ES to project what you owe. 5 minutes of preparation averts hundreds of dollars in fines every year for the remainder of your retirement. Item number 2. The tax system eliminates up to $35,750 in yearly tax protection. While you were employed, every dollar you deposited into your traditional 401k decreased your reportable income dollar for dollar. In 2026, the employee deposit ceiling is $24,500. If you are 50 or above, you can include a catch-up deposit of $8,000, raising the total to $32,500. And if you are between 60 and 63, the new enhanced catch-up from the Secure 2.0 legislation permits an extra $11,250, raising the ceiling to $35,750. That is $35,750 annually. That does not show on your W-2. It does not get levied. It does not factor into your adjusted gross income. It does not influence your provisional income for Social Security taxation. It does not influence your premium adjustment calculation for Medicare costs. It is hidden from the tax authority until you extract it decades later. The moment you retire, the protection disappears. You can still deposit into an IRA, but the ceiling is merely $7,500 or $8,600 if you are 50 or above. And IRA deposits demand earned income. If you have no earned income during retirement, you cannot deposit into an IRA whatsoever. The difference between $35,750 in 401k protection and $7,500 in IRA protection or nothing. If you have no earned income is $28,250 annually of forfeited tax shielding at a 22% marginal bracket. That is $6,215 annually in extra taxes that you were not remitting while you were employed over a 5-year span. That is above $30,000 in forfeited tax protection. and that protection was serving dual purposes. It was diminishing your present tax obligation, and it was accumulating your retirement reserves simultaneously. When it vanishes, both advantages vanish. Here's what you do regarding it. In your concluding years of employment, maximize every dollar of deposit capacity accessible to you. If you are 60 to 63, push the enhanced catch-up to the maximum. If your employer provides a Roth 401k alternative and your revenue is under $150,000 in Medicare wages, direct those catch-up deposits pre-tax to secure the write-off. Now, if your revenue exceeds $150,000, the catch-up must go Roth. So, you remit tax now, but the funds compound tax-free permanently. Every dollar of deposit capacity you leave untouched in your concluding working years is a dollar of tax protection that is eliminated forever. Did you realize that you forfeit up to $35,750 in tax protection the moment you retire? Leave yes or no in the comments. This is the one that most individuals have never contemplated. And if sufficient numbers of you respond no, I am producing a complete video on how to maximize your concluding year deposits. Item number 3, the tax system eliminates your health savings account deposits, and the HSA is the singular most tax-privileged account in the complete tax regulations. It possesses what financial experts term the triple tax benefit. Deposits are tax-deductible, decreasing your AGI. Appreciation is tax-free, and distributions for eligible medical costs are tax-free. No other account in the country accomplishes all three. In 2026, the HSA deposit ceiling is $4,400 for single coverage and $8,750 for household coverage. If you are 55 or above, you can include a catch-up deposit of $1,000. Your company may additionally deposit to your HSA beyond your personal deposits, and those company deposits are tax-free to you as well. Here's what occurs when you retire. If you're below 65 and you transition to marketplace medical coverage, you can continue depositing to your HSA provided you are participating in an HSA-compatible high-deductible medical plan. But most marketplace options and most retiree medical options are not HSA-compatible. So for numerous individuals, HSA deposits halt the moment they depart their company's high-deductible plan. If you are 65 or above, it becomes worse. The instant you register for Medicare Part A or Part B, your HSA deposit eligibility falls to nothing. You cannot deposit another cent ever. Federal statute forbids HSA deposits for anyone registered in Medicare. If you deposit after registration, you owe a 6% excise levy on the surplus amount annually it stays in the account. The window shuts permanently at Medicare registration. And since most individuals are automatically registered in Medicare Part A when they begin receiving Social Security, numerous retirees do not even comprehend their HSA deposit opportunity has ended. But here's the aspect most individuals overlook. You can still utilize your existing HSA funds tax-free for eligible medical costs for the remainder of your days. You can utilize it to cover Medicare Part B charges, Part D charges, Medicare Advantage charges, deductibles, co-payments, and medication costs, all tax-free. The sole restriction is you cannot deposit additional funds. This is precisely why the final several years of employment before retirement are so vital for HSA building. Every dollar you deposit decreases your AGI currently, appreciates tax-free, and emerges tax-free for medical costs afterward. If you have been under-depositing to your HSA because you assumed it was merely a spending vehicle, you have been ignoring the finest tax arrangement in the regulations on the table. The solution is straightforward. Maximize your HSA every year for the balance of your professional life. If you are 55 or above, incorporate the catch-up. If your company deposits, verify you're depositing the ceiling above that. Accumulate the HSA funds as substantial as feasible before the Medicare window closes, because afterward, you can utilize it, but you can never supplement it. Let me demonstrate what this represents over a lifetime. A couple in their late 50s who both maximize individual HSAs at $4,400 plus. The $1,000 catch-up with company deposits of $1,000 each are directing $12,800 into HSAs annually. At a 22% federal bracket plus 7.6, 5% FICA reduction on employee deposits, the yearly tax advantage is roughly $2,200. Over 5 years prior to retirement, that is $11,000 in tax reduction. Additionally, the HSA funds have accumulated to above $64,000 invested and compounding tax-free. That $64,000 will fund roughly 6 to 8 years of Medicare Part B and Part D charges, co-payments, and medications, all distributed tax-free. If they had directed that identical money into a traditional IRA, they would have obtained the write-off entering, but remitted ordinary income tax exiting. If they had directed it into a Roth, they would have obtained no write-off entering. The HSA surpasses both because it receives the write-off and the tax-free distribution. No other account achieves this. There is one additional scheduling pitfall with the HSA that virtually nobody clarifies accurately. If you're intending to postpone Medicare beyond 65 because you are still employed and protected by your company's high-deductible plan, you can continue depositing to your HSA. But the instant you register for Medicare Part A, even retrospectively, deposits must cease. And here is where it becomes precarious. If you apply for Social Security after age 65, the Social Security Administration mechanically registers you in Medicare Part A, and that registration is retroactive by as much as 6 months. That signifies if you were depositing to your HSA throughout those 6 months, those deposits are now surplus deposits subject to the 6% penalty. The solution is to cease HSA deposits no fewer than 7 months before you intend to apply for Social Security. If you are beyond 65, or postpone both Social Security and Medicare concurrently if you desire to maintain the HSA deposit opportunity open. This demands synchronization between 3 distinct government frameworks, SSA, CMS, and the tax authority, and virtually nobody executes it properly without expert assistance. If you have stayed with this video to this point, you are precisely the sort of individual this platform is designed for. Press the like button immediately. It requires 1 second, and it signals the algorithm to display this to additional pre-retirees who must absorb this before their concluding day. And if you're not subscribed, do it immediately. The video I am releasing next week on which month to retire will preserve some of you substantial money. Item number 4, the tax system eliminates your pre-tax medical insurance premiums. This one is undetectable while you're employed, which is precisely why it stings so intensely when it vanishes. If you carry employer-provided medical insurance, your premiums are almost assuredly remitted with pre-tax dollars through what is termed a Section 125 cafeteria arrangement. That indicates the funds exit your paycheck before taxes are computed. It decreases your W-2 revenue. It decreases your adjusted gross income. It decreases your Social Security wages. It decreases everything the tax authority utilizes to determine what you owe. For a standard employee remitting $500 monthly in medical insurance premiums through a cafeteria arrangement, that is $6,000 annually that is extracted from reportable income before the tax authority even observes it. At a 22% federal bracket plus 7.65% FICA, the tax reduction on that $6,000 is roughly $1,779 annually. You never detect it because it transpires automatically within your paycheck. The moment you retire, that pre-tax treatment vanishes. If you transition to the marketplace exchange, your premiums are remitted with after-tax dollars. Certainly, you may obtain a premium subsidy that counterbalances the expense, but the premium itself is not a pre-tax subtraction from your revenue the manner employer premiums were. If you register for Medicare, your Part B and Part D premiums are subtracted from your Social Security payment, but they are not pre-tax subtractions from your AGI. The functional consequence is that your adjusted gross income during retirement is elevated compared to what it would have been if you still possessed the pre-tax premium advantage. Elevated AGI produces elevated provisional income, which produces greater taxation of your Social Security. Elevated AGI produces elevated modified adjusted gross income, which produces greater surcharge vulnerability. Elevated AGI produces diminished qualification for income-dependent deductions and credits. The $6,000 that was imperceptible while you were employed is now apparent to the tax authority. And the tax authority bills you for it in 3 distinct manners: income tax, Social Security taxation, and Medicare surcharges. There's a partial substitute. If your healthcare costs, incorporating insurance premiums, surpass 7.5% of your AGI, you can subtract the surplus on Schedule A if you itemize. But with the standard deduction at $32,200 for a married couple, most retirees do not itemize, which renders the healthcare expense subtraction inaccessible. The pre-tax advantage is simply eliminated. The sole genuine solution is consciousness. Recognize that your AGI will be elevated in retirement than you projected because of this imperceptible advantage vanishing, and modify your provisional income and surcharge projections correspondingly. If you are forecasting retirement revenue, incorporate back the medical premium amount that was formerly pre-tax. That provides you the authentic figure the tax authority will observe. Item number 5, the tax system eliminates your employer contribution. This is not a tax write-off. It is something superior. It is complementary funds that were appreciating tax deferred within your retirement account, and it terminates the moment you depart the building. If your employer contributed 50% of your deposits up to 6% of your compensation, and you were receiving $100,000, your employer was directing $3,000 annually into your 401k above whatever you deposited. That is $3,000 that did not originate from your paycheck. You did not generate it in the conventional sense. It materialized in your account because you participated and deposited over 5 years. That contribution totals $15,000. With 7% yearly appreciation, it is nearer to $17,500. Over 10 years, it is above $41,000 in complementary funds plus appreciation, all tax deferred. The moment you retire, the complementary money pipeline ceases. There is no substitute. There is no IRA contribution. There is no government contribution for retirees. The employer contribution is an advantage that exists solely while you are on payroll, and the instant you depart, it is finished. Now, some individuals cite this as a rationale for continuing to work, and for specific individuals, that is sensible. If you are 59 and your employer contributes dollar for dollar up to 5%, that is $5,000 annually in complementary funds on a $100,000 compensation. Remaining one additional year for that contribution could be justified.